G'day, everyone, and welcome to Seven Questions, a podcast that shares the stories and compelling lessons founders, investors, and leaders shaping our economy. I'm your host, Elaine Gerard, founder and investor at Partner. Through Seven Questions, we explore the founder and growth company journey from idea to exit, uncovering the insights, lessons, and defining moments that shaped each founder and the amazing business they built. Whether you're a first-time founder, serial entrepreneur, investor, or someone looking for insights on entrepreneurship and what it takes to build a world-class company, these conversations are designed to inspire you, get you thinking, and hopefully you'll find some timely wisdom that propels your journey. G'day, everyone, and welcome to Season 2 of Seven Questions. I'm your host, Wayne Gerard, and this season we're talking about high growth company governance. What's it like to support some of Australia's fastest growing and most potential companies from a governance perspective, from a board perspective? How do boards help high growth companies really achieve their maximum potential? Today, I am joined by an amazing friend of mine, someone I've known for 15 years. Elaine Stead. Elaine has such an incredible background, so much experience, and I am genuinely excited to have this conversation with Elaine. Elaine is currently an investor at Main Sequence Ventures, and she looks after their health tech portfolio. Elaine's career in innovation and growth companies spans a couple of decades. She's been on more than 30 boards, both as an investor and also as an independent director. She's also been an entrepreneur. So she has literally seen this topic from all three sides. Elaine, welcome to Seven Questions. It's so great to chat with you.
Hi, Wayne. It's so great to be here. Thank you for inviting me on.
I am super excited for this conversation. We are going to go through 7 questions about, growth company governance. And really the topic is relevant to any organization, any founder, manager, owner, or board member of a company that is going through high growth. That doesn't matter if they're public or private. There's a lot that we're going to talk about and hopefully some really valuable lessons and content for the people listening. Before we start, let's really get to know a little bit about Elaine and her journey as both an investor and a director. Elaine, do you just want to kind of walk us through some of the highlights and some of the things that have really helped you to, I guess, cement the way you think about high growth company governance at the moment?
Yeah, I'll try and do it in brief, and then if there's anything you want to dig into, by all means, do that. But started out as a scientist back in the day, so have been involved in technology-driven, innovative projects for a really long time, my entire career. But realized early on that probably didn't want to be a research scientist for the rest of my career. So kind of pivoted to the business side of research, which was really, in that first instance, working within the biotech industry. That was a way that I could continue to kind of keep my fingers into the bleeding edge of the technology as it was being developed at the time, but also work within more of the business side of what that entailed. So commercializing technology, translating it into something that could actually be a product, what that pathway was, and liaising with potential industry partners, building out commercial plans, and so forth. And that made me really realize I love the business side of innovation and technology-driven innovation in particular, so deep tech. And then over time, that led to me actually spinning out a technology which was in the healthcare and in the diagnostic space. And that's where I got my first taste of being a founder. Like, what's it like to build something from scratch, to have to wear many hats, to have to raise the capital, to be the magnet for talent, to make sure that you were dotting the I's and crossing the T's, to build a universe of people around you who could actually be helpful, because you literally cannot do it all. And that led me to raising venture capital for that business. That led me into the venture capital industry. I got headhunted by one of the firms that I had pitched to after we raised money and we brought on a new CEO. I went and joined that venture capital firm, and I've been in venture capital ever since. So this year, it's actually my 20th year investing as a venture capitalist, with a small break in between where I worked for some venture-backed companies to do more operational roles, because I think one of the lenses that you sometimes lose as you spend a lot of time as an investor is what it's like to work at the coalface within high growth startups and actually what is involved operationally. And I think just having that perspective can make you a better investor, but more importantly, a better board member, which is one of the ways in which an investor plays a role in venture-backed companies. And so that leads me to now. And over that period, I've been on probably more than 30 boards, mostly private, some listed. I have been an investor director. I have been a founder director. I have been an independent director. And so hopefully for this conversation today, I can bring a bit of a lens of each of those hats that directors wear as we talk about board and governance.
Elaine, congratulations. Like 20 years in the investment ecosystem in Australia is really puts you at the beginning of that wave. And I'm sure you've seen a lot happen as the ecosystem's matured, as we've got more early stage high growth companies. We've seen an influx of venture capital funding and also private equity funding into the sector. So it's really exciting. And I'm sure there are lots and lots of lessons if you take the time to reflect back over the journey. We'll start with question number one, which is that, really a question around, at what time, what's the right stage for a high growth company to begin formalizing its board and governance?
Yeah, it's a great question to start with, because I do think there's a lot of flexibility about when you do start. I guess the headline would be start before you think you need it, because it's usually, if you do it well and you do it right, you want to take the time to build out the right governance that's fit for purpose for your company. And so the more time you can spend, the more time you have to weigh into that and make sure you get it right, the better. I will say, though, that practically where most companies start to formalize their board is when they take on their first external capital. That's usually the trigger that prompts them to do it, because as we were talking about before we started recording, being a founder, you've got so many things you're trying to do at the same time, many hats you're wearing. You're often doing more than one or two full-time jobs. And so it can feel like something that you don't need to prioritize. But I think as soon as you start to take on that first check of investor capital, you then owe it to those investors to build around the company the right sort of governance structure so that they can feel comfortable that decisions are being made well, that there are the right people with the right expertise around the table to help you make those decisions, and hopefully set up some processes that just make sure that that there is the level of de-risking that is fit for purpose for where you are at that time.
Makes so much sense, Elaine. Like, if you were to put your investor hat on at the moment and look at an early stage company that you might think about investing in, having good governance around that company, how does that influence your investment due diligence, your investment decision, and any actions that you might require the company to take prior to making an investment?
Well, really, like if you think about what is the function of a board, so if we're talking about governance, I think for the purpose of this conversation, we're talking about boards, and the role of a board is to make decisions that are in the best interests of all shareholders, or the majority of shareholders. I say that because there's always maybe one or two shareholders for whom a given decision might not be the most ideal, but on balance, are we making decisions that are in the best interests of the company and therefore all shareholders? And so as an investor, when we see a company has a functioning board that has the right procedures and systems in place to make those decisions with the lens of what's in the best interest of all shareholders, that gives us a lot of comfort that those decisions are going to be made properly and, with the right sort of fiduciary intentions, as opposed to it being decisions that are made because they're in the best interests of one shareholder, whether that be an investor, whether that be a founder, or any shareholder for that matter. So that's one of the key things we look for with that governance setup. The second, I think, which feeds into that is, do the decision makers have the right experience in order to make those decisions in the best interest of all shareholders? Do they have people who are experienced in the particular sector, for example, that they might be operating in? In my current role, a lot of the boards I sit on are in biotech and health tech and healthcare. So are there people around the table who really understand that sector, understand what's required to bring something to market, and can provide some advice that's actually useful and relevant and adds value to the conversation? Ideally, is there an independent on the board who can be that independent voice, which helps to try and balance some of the voices around the table that might have vested interests? And, I think people rarely at a board level are overtly trying to advocate for their own interests, but, you put some boundaries and guardrails in place through some of these systems, like appointing an independent, to try and make sure that if there is some sort of bias that's creeping into some of these conversations, that independent voice can actually be truly an independent voice that can help mitigate some of those things. So it's really about, I think it's about mitigating the risk of there being decisions that are just not in the best interest of both shareholders. And that's what we look for primarily.
Makes so much sense. One of the things that I kind of look for or like check off when I see an early stage company or a high growth company has a board is, I'm thinking about, if the board's in place, then likely they've got a good cadence of board reporting. And so therefore they're doing good financial reporting. So therefore you've got good information access, and those kind of disciplines that an organization puts in place when they have a board really help to give shareholders and investors a level of insight into the past performance of the company and also its approach to decision making, for example.
Correct. And I think where you were heading with that, which I think is actually at the foundation of all of this, is trust. So if you build a good board with good reporting, good systems, all of those procedures in place, then investors and shareholders should be able to trust that they're getting the information that is important for them to know, that they have the right to know, that, there isn't something missing that's going to be a liability for them as a shareholder down the track. And if there is, there are mechanisms and systems in place to try and address it. So I think what you're doing as a founder when you assemble a board is you're helping to cultivate an essence of trust that your investors and shareholders can leverage and give them a lot of confidence.
So with that, let's jump on to question 2, which is really a where should you start kind of question. And I'd love to hear from you. What's some of your advice or some of the feedback that you would give to a founder, a CEO, a business owner who's thinking about setting up a board, putting in place that governance? Where should they start?
Well, firstly, I think they should, and this is going to sound a bit trite, but I think it's important, is I think they should do a company director's course. So I think there are a lot of founders in particular of early stage businesses that have anecdotally learned what it means and requires from board directors, but actually hasn't been through the real work to understand truly what that means, what the obligations are and what the consequences are, and ultimately what their fiduciary duties are. So that would be number one. And I think by doing that, it informs you as the person undertaking those courses, but it also helps you to understand what you need to build around you in order for that board to meet the governance requirements that you need to meet for the company. The second piece of advice I would say is assembling a board I'll come back to that point about trust. Governance isn't assembling, a group of agreeable people who are going to say yes to whatever you present, right? If you've got a board that is in complete agreement with things that get presented or strategies you would like to undertake or projects you want to do, or then that's like a red flag for me and for most investors or shareholders, I think. It's your opportunity to build a group of, like a council of elders around you, for want of a better term, who have maybe seen some things that you haven't, who have embarked on things that you have not yet, who can bring some of those scars and mistakes that have been made previously to the conversation to help you avoid doing them yourself. And I think that is ideally what you as a founder are trying to build. And so, and that's hard, right? That's hard to do as a founder, is number one, to bring on to your company that you have started a group of people who may not agree with you, and then be okay with taking their counsel and have the chips fall where they may, with the right sort of systems and governance in place. If you are not prepared to do that, then you shouldn't be going down that route. And I do think there are a lot of people who will say they want to build a board around them to provide that guidance and counsel and governance guardrails. But when the rubber hits the road, it's actually hard to do. It's hard to have people disagree with you. But I think if you build a group of people around you who, even if you might disagree with them, you have done the work to build the trust with them, that even if you know they disagree with you, their goal is to do what's in the best interest of the business. And that has come through because you've done the work to build that trust with that individual or that group of people as a whole. That's where it's working well. And that's where you get a really functional board. It is not just picking a bunch of people and meeting every quarter, every month, every 2 months. It's about opening yourself up to having this input, and then putting your confidence in the fact that that group of people are going to do what's in the best interest of shareholders based on the information they have at the time.
I love it, Elaine. So, if I was to summarize that really quickly, I would say the first thing you said is founders or business owners who are looking to put a board around them should go and do an AICD course, company directors course, or equivalent training that helps them to really understand their fiducial responsibilities and what is a board and how should a board operate. So that's kind of number one. Number two is getting the right people around you. And I often talk about, you want the different voices around the table. So you talked about the voice of the customer, someone that understands the problem. You talked about the voice of the operator, someone that has kind of lived the journey previously, the voice of an investor, someone that understands what it takes to raise capital and put in place all those kind of things. And then there are other voices as well, and they're relevant depending upon the type of organization. And so I think about having the right voices of the right stakeholders around the table. Yeah.
Also
I love it.
diversity. So not just
Diversity as well, right?
diversity of like different sort of stakeholders in the value chain, but also like, if you're somebody who's perhaps very operationally minded, but not very relationship minded, maybe put somebody on the board who has that skill set and can bring that to bear. Or if you're terrible at fundraising, maybe bring on a chair who actually brings those networks, who's actually really good at that. So sometimes it's the voice of a stakeholder, but sometimes it's a skill set or an approach or a personality type that is really critical in order to build the skills matrix that you need on the board at the time.
Yeah, I totally agree. I think back to the first chair I had at Red Eye, and he was a really, really senior executive from one of the world's biggest companies. And so he had this diversity of thinking because he operated at such a large scale. And then he'd look at where we were operating, and we were like, millions of dollars, tiny little company. He was like 10 orders of magnitude bigger. And he just had this completely different scale and diversity, and taught us not to sweat the small things, and taught us to take time on things and to make better quality decisions. And yeah, so there is a lot that you can put around that. And then I think the third thing that you touched on, which is really valuable, is the being open to the feedback, the being open to the different points of view, the being open to to points of view that are counter to your point of view as a founder or a business owner, and being willing to take that on board and leverage it as a benefit rather than kind of reacting against it. So, super valuable answer to question number 2. Let's jump on to question number 3. And this is, I think, super important. It's a question about how, as a board member, how do you balance governance with preserving that speed and entrepreneurial culture that made the company attractive to invest in the first place? So, how do you right time it, right size it, so to speak?
Yeah. And I I think a really functional board and governance setup should remove friction rather than create friction. And I know that might sound counterintuitive because, you know, if you have a board in place, there's going to be some level of bureaucracy involved, whether it's sharing information, whether it's assembling everybody to meet so that good decisions can be made. But the cadence in which that happens and the way in which information is shared tends to be the thing that slows it down. It's not the very act of, providing information to your board members or getting them on the phone to discuss something that might be happening. Like I've been on boards with very early stage companies where we've had to meet several times a week to just deal with something that's ever evolving. And you do that. And that is never a hindrance to operating at speed. The hindrance that tends to get in the way of operating at speed is when the board meetings are the things that are used as the vehicle for decision making. Whereas, perhaps you only meet every 2 months. Well, yeah, if you only meet every 2 months, that is going to slow down decision making. Most of the startups that I've ever worked with don't do it that way. And then the second is just transparency of information. So I think people who invest in this space or are company directors in the startup space are really okay with not having these very formal processes for information sharing, so long as they trust that the information is going to be shared with them in a timely fashion. And then you can make decisions or have conversations quite dynamically in order to do that. So that's why I say I think if it's removing friction, which I think is largely an information sharing bottleneck or a cadence of meeting bottleneck, you can do away with those things very easily as long as all of that information is being shared really transparently and really clearly. I think the other thing that boards can do for founders when they're functional is they can provide air cover for the founder, right? Like part of the challenge of being a founder before you have these boards in place is you're making all these decisions on your own. You're hoping to hell that it's the right decision, and then if it doesn't work, it's entirely on you. Whereas you bring some of these bigger decisions to a board and you give them all of the information they need to make this decision, and they're open to doing that quite dynamically, then all of a sudden you've got a whole bunch of people who are on your side with what you're now trying to execute. It's the board's decision. You as the founder, if you're CEO, for example, now it's just your job to go execute. You've kind of submitted that idea or that initiative to debate, and everyone's agreed it's the right thing to do. God, that gives you a lot of air cover, I think, as a founder to just go and do that. And so all of these things, I know they can sound like they're a level of bureaucracy, but actually I think they remove friction and allow the founder to work a lot more quickly if they're done well.
Yeah, I love it. Hey, let's jump on to question number 4, which is, what are the signs that a company has outgrown its current governance model? And what's a good way to bring that conversation to, whether it's the founder-led business without a board or with a board? What's the right way to, surface that conversation about, hey, we might need to look at our governance model. We might need to look at our board structure. Things are changing and we might need to change as well.
I mean, I think the quickest way to understand whether a company has either outgrown its governance model or rather just hasn't got the right governance model yet is that decisions are like, it's just not very functional, for example. Perhaps there's back channeling happening rather than things being discussed openly and transparently at a board level. Perhaps there's information that's being withheld for fear of sharing bad news. Perhaps there are directors who perhaps aren't quite as engaged as they need to be. But I find when the board meeting feels like it's a bit performative, like it's theatre, as opposed to actually being um, the the focus of where there is debate and discussion, that's when you know that the governance model isn't working. If one particular shareholder has too much power, that can often be a difficult board scenario as well. Like, sometimes we've seen examples where investors have the ability to override something, for whatever reason. They've got like a lot of US VCs, for example, will often want to appoint 2 or 3 board members at one time, and it gives them just the ability to control the board, for example. That's not always a good thing. And we understand why they do that, but sometimes that can mean it's not very functional. So I just think if you're no longer making decisions, having healthy discussion at a board level, there's lots of things happening around that board. That's when it's just not functional anymore, and you need to look at a different model.
And if you identify a situation like that, the obvious next question then is how do you action that? What do you do? If you're a founder, for example, what advice do you give to a founder if they feel like they've kind of outgrown the current governance model? How would they surface that?
Well, I would say it's not necessarily the founder's job to be the person to do that, right? Like, I think that's the job of the board collectively, of which the founder might be one of them, to kind of surface that this feels like it's no longer functional. Ideally, a chair might be the person who kind of first broaches that. Perhaps they broach it with each of the directors independently to say, look, this feels like it's not working. It feels like, decisions aren't being made in a timely way. Perhaps it's, don't feel like you're engaged, don't feel like you're adding value, feel like you're being adversarial, feel like, whatever is the complaint. And usually, if that gets discussed at a board level, the board, because it's their job, it's their fiduciary duty, it's now a shared responsibility to get that right. And most directors will, if they feel like they're no longer adding value, or someone tells them they're not adding value, they're not going to stick around, right? Most people understand that the functionality of a board is so heavily reliant on trust and feeling like everybody is pulling in the same direction, that once you have been given a signal that belief is maybe no longer held, they'll step up and make room to find a different way to architect this. So I would say I don't think it's the founder's job to do that. I think it's the board's job to do that. But if for some reason, a founder or any director has a sense that they feel like this board is no longer functional, it's their responsibility to raise that as a board and then collectively try and work out the way through it. Where things run into trouble, I think, is when these things are not surfaced or discussed at a board level. Sometimes you'll see, groups take unilateral actions or freeze out particular investors or particular directors, or that is just a one-way street to complete dysfunction and poor decision making. And so the best way to do this is have just an adult conversation at a board level and surface these things and then figure it out.
I think the role of the chair in boards is really important for, it's part of their responsibility is making sure that the board is functional, making sure the board is, supporting and accelerating the performance of the company.
Yeah.
Yeah. So
Great.
definitely if there is a nominated chair, I think, being able to surface a concern to the chair, but I also think the chair should be keeping their eye open on that kind of stuff all the time anyway. What do you reckon?
Oh, I think they should. Like, in an ideal world, the chair is the conduit between the CEO and the rest of the board. The chair works really closely with the CEO to try and be not not standing in the way between, but being a buffer between the board and the CEO. The challenge that we see sometimes in startups is that the CEO is also often the founder and is also on the board. And that therefore can sometimes make that a little bit of a different feast for chairs. So they're not, larger companies having that separation is a bit easier than when you're in the startup world. And the difficulty, I think, for the chair is you often can't kick an investor off the board because the investor is on the board by nature of their investment. They also can't kick the founder off the board if the founder is recalcitrant because they're the founder. And so I do think that adds a degree of difficulty to the chair role in startups. But, then if they're not prepared to do that, exactly. And this is where the trust part comes in, right? And the work that is done to build the relationship with all of those parties so that when the chair does bring this up or when somebody else does bring this up, you have an adult conversation.
Totally agree. So we've just talked about, when companies outgrow governance. On the flip side of that, when have you seen a board add stacks of value to a growth company?
Oh, it's hard to answer this question in a way that doesn't sound self-serving, but in many occasions, I can see sometimes the way that the board has added stacks of value is adding air cover to the founder to just let them go, right? Like I've been involved in some companies over the years where the technology, the product, the founder is just flying. And the role of the board is it's not to not get in the way. It's how can we make sure everything else is running really well and we're putting the right processes and systems in place to make those decisions easy and still bring the wisdom of the crowd to bear, but let the founder go. And that is adding as much value as the boards who bring networks and partnerships with industry and magnets for talent and reputation and credibility anchors for founders. I often think there is a lot of minimizing all of those ways of adding value. And, some VC and investors will often say, well, the best we can say we were in the room. And that is true because you're not on the ground at the coalface doing the work. But without all of those things, probably the founder couldn't do what they needed to do, or they weren't bringing the right expertise and experience to bear to avoid some of those mistakes. So I've seen that a lot all the time. Definitely seen some dysfunctional boards and boards that don't really add a lot of value. But I think by and large, most boards, if they're operating well, are working quietly in the background to build the foundation so that the company can do what it's meant to do.
Yeah, I look at some of the directors I work with on a couple of different boards, and one example is one of the directors is like, hey, this company has now got to the point where we need a risk management matrix. And so worked with the founder and the exec team to help put in place that kind of governance around risk and risk mitigation that the founder just didn't have the capacity or the focus on because they were busy growing. And so it was a real value add for the founder. And the founder was like, wow, you helped so much. You identified a couple of things that I wasn't thinking about, et cetera, et cetera. So, supporting the founder with the implementation of what I call right timed, systems, processes, cadences, tools, along with all the things you just said and, brand and reputation, access and network, experience, all those kind of, good judgment, all those things that really help add value to a board. Let's jump on to question number 6, if that's okay. And that is, what does a productive relationship look like between investors, founders, management, independent directors, the chair? What does it look like and how does it evolve as the company scales?
I would say healthy conflict is the feature, not the bug in productive board amongst all of those stakeholders you just mentioned. I think I started by saying, if If you're just going to build a group of people around you that are going to agree with you, you're doing it wrong. The challenge for a lot of boards is how to have that healthy conflict and disagree well. And by disagree well, I mean, surface your views or your opinions in a constructive way. That doesn't mean that you're not going to have difficult conversations. That just means that you, as a board, need to have a culture and a environment where people feel okay to raise either dissenting views, challenging perspectives. They do it in a way that's not threatening or adversarial, but disagreement isn't adversarial. And sometimes even emotion in these discussions isn't adversarial. It is just that you've got to surface these things in a way that people will hear it. And I think that, but then the flip side is that those opinions need to be taken into account and listened to, and all information needs to be surfaced. If you don't have healthy conflict, transparency of information, and a real openness to information and new ideas, then you won't have a productive board. But that productivity that I just spoke to, that isn't assembled, that's built. That takes work over time to build. And I think that gets underestimated. I think people think you can just put people on a board, and they've got these fiduciary duties. They have to then make the decisions that are best interest of all shareholders. And that is a fair fee. You need to take the time to build the trust, to build those relationships so that people know that they're getting the information that they need, that they have the intent that they have when they make a lot of these comments. And that's a multi-year process usually, and you've got to just do the work.
One of the things that I've seen in this domain is, and it kind of builds off that, right? Like, so when you're talking about the board getting together and over a multi-year period taking the time to genuinely build trust and relationship and to practice, I would call it thoughtful and authentic communication with the purpose of communicating messages that other people can hear as opposed to just putting a point out there. One of the things that I guess I look to is how high growth companies, as they scale, as they grow, how they add things like board subcommittees as a way to support the prioritization of different initiatives or to respond to different priorities that happen throughout the year in a way that enables the board to continue to operate effectively without getting bogged down.
Sure. And I think in most circumstances, early stage companies don't need those subcommittees. But it's not really a function of your size. It's more of a function of, typically these subcommittees get broken down into like audit and risk committee or, remuneration committees. And the purpose of those committees is to try and minimize how much time is spent on a list of things that a board might need to do. So if you can sort of separate out some of these functions, that means half the people need to be in those meetings, not the entire board, which can sometimes make it a lot easier to get those things done. And then they feed up to a formal board meeting where the board knows that members of the board have looked at this, they've done the work, and they've made a recommendation up. So that sounds bureaucratic, but it removes a lot of friction in doing that. That's often a function of the sector you're working in and, for example, how much risk there might be, whether you've got stakeholders who perhaps have really significant reporting obligations. But if you don't have a lot of those things, then you probably don't need those subcommittees, and that would be an unnecessary level of bureaucracy, but it can be absolutely helpful.
Yeah, like I'm curious about your thoughts because there are a set of traditional subcommittees that large boards implement, large organisations implement, and AICD talks about. But then I think there are also really kind of relevant subcommittees for high growth companies. So, for example, you might establish a subcommittee around M&A if you're very acquisitive. If you're a PE-backed firm and your focus is on inorganic growth, that might be helpful. If you're a technology-driven company, there might be a subcommittee around, you know, technology architecture, resilience of your technology, you know, disaster recovery, business continuity, AI. Any of those things might end up in a technology subcommittee that really ensures the business can continue to operate.
Sure. Yeah.
If you're a health tech company, for example, and you're going through the various stages of regulatory approval, that might make sense to have a subcommittee focused on supporting the operational aspects of the business to get those accreditations, approvals, regulatory sign-offs in place, for example.
Yeah. And so it's about just dividing and conquering, right? Rather than having to assemble your 5 board members for all of these decisions or all of the work you need to do to interrogate those decisions or that particular function, you can assemble 2 or 3 of them. And it just means you can work more quickly. It's a great idea if you've got, and also if you're trying to concentrate the expertise, like, as you get bigger, your boards are more diverse in their expertise. Probably makes no sense to have the person on the board who has absolutely no expertise in that area on the day-to-day conversations about, M&A, for example. But you do absolutely want them to be part of the decision when it comes to having to make this decision on behalf of all shareholders with all of the information in its totality.
Yeah, really cool. Like, I think as a high growth company scales, the ability for the board itself, and if you decide to put in place subcommittees, uh, those strategies can really help the board scale with and support the company through its various, milestones and activities. Hey, looking back, Elaine, across your investments, what governance practices do you wish more founders introduced earlier? What's, for example, one mistake that you would love to help founders avoid?
I think consistent, honest reporting from day one is the one thing I would say is a mistake I see a lot of people make, scared to share negative or difficult information. You can't deal with a problem if you don't bring it to the wisdom of the crowd to help solve it. That's the thing that gets companies into trouble, is when there's not transparency of information and honesty in the communication. And I think the other is thinking that their board is there to as like a tick box exercise, like a governance. Like it's an annoyance to them to have to go through this. Like, they do it because they have to, but it's not really useful. I think your board is as useful as you make them, as you. It's your responsibility as a founder to make the most of this group of people. And granted, you can bring people on your board who aren't the right fit. But I think if you've got multiple board members cycling, or you've got really good people leaving from your board, that's an indication that it's not the board, it's how you're using them. So I think honest and transparent communication, and really use your board in the way it was intended. Don't see it as a governance annoyance. Use it as the guardrails that you need to give you the air cover to do what you want to do.
I love it. I love it. That is a super great set of wisdom to finish our formal 7 questions with, Elaine. Thanks so much for sharing all of your,
My pleasure.
I guess, and not even all of, just sharing your ideas and some of the things that have really stood out for you. I can't let you go without doing a rapid fire set of questions. You ready for 7 rapid fire high growth company
Sure.
governance questions? You get to
Sure.
answer one way or the other. You ready?
Okay.
Okay. Founder, investor, or independent chair?
Independent chair.
Do you value experience or diversity?
Diversity.
Love it. Monthly, bi-monthly, or quarterly board meetings?
Monthly, at least
Monthly.
to start with. Yep.
Yep. I love it. Online or in person?
In person is best, but also understand we live in the digital world today, and that's not always possible. But in person, ideally, that's how you build
Totally.
relationships.
Yeah, that's how you build that long-term trust. One attribute you look for in a great growth company director. Just one.
Honesty.
Honesty. Yeah, very cool. Formal board or advisory board?
Advisory early and then formal board.
Cutting it both ways. Okay. You get that one. And last one, what is one word that describes a great growth company board?
Brave.
Brave. Elaine Stead, thank you for joining me on 7 Questions, Season 2, High Growth Company Boards and Governance. You've shared so much today, so many good ideas, really practical bits of experience that you've gained. And like always, it's a pleasure to have a conversation with you to hear how thoughtful and considered you are. And I'm sure the board you're with today and the companies you support through Main Sequence Ventures really get a lot of value out of having your wisdom and your generosity and also your authenticity, supporting them grow. I love having you as a friend and I appreciate everything you do in the ecosystem. Elaine, thanks for joining us on 7 Questions.
Oh, likewise, Wayne. Thank you for having me.
Thanks for listening to this episode of 7 Questions. If you'd like to learn more about the founders, you can get a link to the full show notes in the description below. Have a great day. We look forward to you joining us on the next episode.